I would say that anything you're doing, if it's not in the service of others, you're going to find yourself not happy. So just make sure whatever you're doing is in the service of others, whatever it is. You have to add value to people's lives somehow, some way, and be compensated for it. And then you can feel really, really good, and your sense of self-worth is probably going to be sustainable. I have a saying, which is concentration creates wealth, diversification preserves wealth.
Welcome, millionaires and future millionaires. You're listening to the Millionaires Unveiled podcast, a show where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their portfolio allocation. Now to your host, Jace Mattinson.
Welcome back to another episode of the Millionaires Unveiled podcast. This is episode number 404.
This is the podcast where we dive deep into the inspiring stories of self-made millionaires from all walks of life. We are your hosts, Jason and Stacy, and each episode we uncover the strategies, setbacks, and turning points that led these individuals to financial freedom. Whether you're just starting out or looking to level up your wealth-building journey, join us as we share the secrets and wisdom from those who have built their fortunes from the ground up. Get ready to learn, be inspired, and take actionable steps towards your own success.
Thank you for all those birthday wishes. I appreciate it. I've got the best listeners in the world, that's for sure. You definitely made the host feel special this weekend, so appreciate it. And thanks to all those listeners tuning in general. We've got a lot of new ones coming in from all over the world. And I think a lot of uncertainty around the markets, and people kind of get back to the basics and thinking about personal finance again and what they can do to get an edge and continue to build wealth. And we've had a lot of volatility in the markets. So it'll be interesting in these interviews coming up that we record, what kind of adjustments people have made in their portfolios or what they're doing and what kind of, unrealized losses that they may have seen. So, we'll have to get into it. So, today's actually, before we get into that, if you'd like to be on the show, send us an email, millionairesunveiled@gmail.com. We're always looking for new, great, entertaining guests willing to share their stories. And with that, today we've got Dave. He's got a net worth north of $10 million. He's the financial planner and owns a restaurateur. He's owned a restaurant group, or part owner of that, part owner of his financial planning practice as we get into. And so he's got quite a bit of net worth tied up between those two businesses, but does have a few million in some real estate, some personal residences that he enjoys, and then some other investments in the market and whatnot. So going to be a great episode with him. And without further delay, let's get right into it with David.
David, you want to just give me a little bit of background and what you're up to now?
Well, from a professional perspective, I am the founder and CEO of a financial planning company called One Wealth Advisors. And I'm also the founder and executive chairman of a restaurant company that has 7 restaurants with 3 more opening over the next year, and a consumer packaged goods business that I started as a sort of side hustle with one restaurant and turned it into a real company. Now I do both. And personally, I am a big snowboarder, a mountain biker, and split my time between San Francisco, Lake Tahoe, and New York City.
Awesome. I can't remember the last time we had a restaurateur on, so this is going to be kind of fun. And then the advisory stuff too. So before we get into the details of career path and all the fun stuff you're doing, what's your net worth today?
North of 10.
Awesome. And how is that broken up? Or how do you think about the global asset allocation there?
Well, there's a big difference between income and net worth. And when it comes to net worth, the question is, what do you get for your net worth? I mean, I have a substantial portion of my net worth tied up. I don't like that word because I love having it in my private companies. I own north of 30% of my financial planning company, and I own north of 25% of my restaurant company. There's no place to sell the stock. I get pretty good income from them, and I guess the valuation is very high. That probably accounts for 40% or 50% of my net worth, and probably 30 to 40% of my net worth is in real estate. I have 3 properties, and the remainder is in highly diversified index fund type investments.
And let's talk about the real estate real quick. Are those all primary residences, or do you have some commercial in there as well?
All primary residences. I'm not a real estate expert. I like using real estate, and the fact that it is part of my net worth probably matters more to my heirs than it does to me. It just means I have 3 places I love being and get to use, and I don't rent them out. Although I could rent 2 of the 3 when I'm not in the 2 of the 3 if my income ever required it. Thus far, it hasn't, so I don't. So yeah, it's not that I'm anti-commercial real estate, although anybody listening that understands cap rates probably understands that maybe now is not the greatest time to go into commercial real estate, but I digress.
And of those properties, are they all paid off, or do you have mortgages on any of them?
Yeah, I was fortunate enough to, or smart enough, I guess, to put some mortgage debt on one of them before rates started to spike, and so now I have 3% kind of mortgage, and I'm probably never going to pay that off more than I have to because it's so cheap. I can make more investing the cash that I would otherwise use to pay it off.
So mortgage on only one of them then?
Yeah.
And did you buy that one initially in cash and then
No,
went
I
and put a
built
mortgage
it. It's
on
a
it?
ground up construction, and so I did a
Okay.
construction loan, and I put up 60 or 70% of the cash to build it, and the bank lent me, I think, 40% or so.
Okay, cool. And the ones that you have paid off, did you buy those in cash initially, or you just had accelerated pay down on the debt on them?
I paid cash.
Okay, so paid cash for first home and paid cash for a second home. Did that always start like that, or did you have a
No,
mortgage early on?
no. I mean, when I first started buying real estate, residential real estate, as a younger person, I needed to borrow the money. It wasn't an asset allocation decision. It was the only path to entry decision. The government incentivized us to borrow $750,000 on a primary or second mortgage, a second home. And even if with rates at 7%, if you're in a pretty high tax bracket, the deductible nature of that is pretty compelling. So if where you're going with this question is, would I advise somebody to get a mortgage? My financial planning company, we always recommend clients, even those that have, $100 million net worth, we still have them have a $750,000 mortgage because of the tax advantage nature of the interest you pay the bank.
Yeah, and I'm not so much like advising on this. I'm just curious, kind of the thought process of, most people don't have a house paid for in cash, let alone 2. And you mentioned going back in the early days where you did have to borrow money. What has been the thought process on those other ones of just, is it peace of mind? Is it just the opportunity, that you had to pay them off because of income that, might as well? Or, I mean, kind of walk us through that. It's kind of an interesting proposition to be in, and congrats to you. I mean, most people I dream of paying off one house, let alone having the second one owned in cash.
Well, I mean, when you're there's a big difference. There's 2 pretty big binary differences. One is, can you actually afford to buy a place for cash? And if you can, then you're making a choice to borrow money or pay cash. And if you can invest that money, make a higher return than you pay the bank, minus the tax benefit deducting against your income, well, you probably should have at least the $750,000 mortgage, even though you could afford to pay cash. So it's an asset allocation, sort of asset optimization decision. The other binary thing is the mortgage on my place is like 3% ish. That same place would be, that same rate would be over 7% now, and it's probably a $5 or $6 million home with $1.9 million of debt on it. So I can only deduct the first 750, but it's at 3%. And so I know I can make more than 3% with that cash from my investments, and it's liquid. I have access to it if I have something else I want to do with the capital. So that's why I in that scenario, I choose to keep even that debt, even though I could afford to pay much of it off if I chose to. But when people are paying 7% and it's not deductible, I think it's probably a mistake, because you can't expect a 7% return from any diversified investment portfolio. So again, I think you're faced with sort of a flow chart like decision making processes. Can you afford to pay cash? And if you can afford to pay cash, then should you have debt, and where are interest rates, and what otherwise could you do with the capital?
Yeah. No, I hear you on that. So let's shift gears on the money that you got invested in the market. Is that in tax advantage accounts, brokerage? Kind of what's the breakup of what that looks like?
I have of my liquid assets, I have probably 65% or so in IRA 401k, and 35% or so in what we call in the investment world a taxable account. That is to say, a non-tax advantaged, tax deferred type account. And you didn't ask, but I'll tell you, 100% of my IRA and 401k is invested in index funds, but all equities. And my non-IRA is invested in all municipal bonds. And the logic there is that I will, if there's money I want to tap into prior to being of retirement age, it's going to be my non-retirement money. And I'm likely to leave my retirement assets or tax advantage, tax deferred assets alone till my 70s. And so for me, my risk tolerance for that entity or those entities, my 401k IRA, is much higher than my risk tolerance and potential short-term needs for my non-IRA and 401k.
Yeah, makes sense. Do you know how much you have split between traditional and Roth, or is there a split at all?
I have no Roth. I make too much money for a Roth. My income's too high.
How long ago did you start putting money into tax advantaged accounts?
I probably started when I was 25 or 27, and I've been maxing out the when I could afford to ever since.
And how many years is that?
Well, I'm 57, so
you got 30 years of
yeah,
close to or maxing out tax advantage accounts. When did you start putting money into your brokerage or your non-tax advantaged
well, I always,
bond account?
I'm an interesting person for you to be talking to, I suppose. I'm not just not because I happen to be, yes, a millionaire, and you're interested in understanding how I think about managing my own money, but I'm also advised 383 millionaires from our financial planning company.
Yeah, we're going to get into that one in a second.
Yeah,
for sure.
And we always recommend people keep 6 months worth of monthly expenses in the form of cash in the bank. Usually a month or two of expenses in a checking account, the remaining in a savings account. And then anything they're going to need cash for in the next 5 years, they then have that amount in, say, medium-term municipal bonds, 3 to 5 year maturing municipal bonds. And then anything beyond that, we have them invested mostly in diversified equities. And so that's the way we think about asset allocation.
And you follow that same pattern.
Yeah, I do. Like. I take my own advice.
Awesome. It's some people that don't sometimes, right? So
no, I know cobbler's kids have no shoes, I think is the saying, right?
Yeah, exactly.
Stacy, you know what's harder than finding the right job? Finding the right person to fill one. When we needed to make a hire, scrolling through endless resumes wasn't going to cut it. That's why we used Indeed. It's like having a hiring assistant that actually works. You post a job, and Indeed does the heavy lifting. With Instant Match, as soon as you post, you get a short list of quality candidates whose resumes are already a great fit. No more hoping someone might be qualified. They already are. And the best part, you only pay for applications from people who actually meet your must-haves. If you're hiring, you need Indeed. Start hiring now with a $75 sponsored job credit to upgrade your post at Indeed.com/unveiled. Offer good for a limited time. Claim your $75 credit now at Indeed.com/unveiled. Terms and conditions apply. That's Indeed.com/unveiled. And thanks again to Indeed for supporting today's episode.
So how long have you been putting money into that non-tax advantaged account? Do you remember when you started that?
It ebbs and flows. I mean, before I built my house, that amount was much bigger. And when I built my house, so that amount was significantly larger. So I've been putting money into that non-IRA, non-401k entity, brokerage account, you may call it. Probably for 25 years, but it ebbs and flows based on, I didn't always have
Yeah.
3 homes. In fact, I used to only have 1 home for a long time. Then when I
Mm-hmm.
bought my second home for cash, well, guess what? That account got a
That's where you
lot
pulled from
smaller.
it.
And then I built it back
Yep.
up. And then I built this home and it got a lot smaller. So
Yeah, no, I understand. That's awesome. All right, well, let's shift gears to the business side. So you've got this financial planning company. When did you start that, or when did you become a partner in that?
I started the practice in 1991, and I was just a sole practitioner working for a regional brokerage firm, acquiring one client at a time, if you will. And then my brother joined me 5, 6 years into it. And we have since, and then we were with JP Morgan for years and hated being there. Eventually got too super bureaucratic. And so we left, I don't know, 10 years ago to start our own independent advisory company. But we took all of our clients with us. It was basically, the practice started in 1991 is the short answer. And we've been sort of building it ever since for 34 years.
Wow, that's awesome. And I want to get into the weeds a little bit because I think it's pretty unique, especially for this show, to have a financial planning company owner. But when did you start the restaurant stuff? And let's talk a little bit about that.
Yeah, I had worked in restaurants all through high school and college, and I grew up pretty poor and had to work basically full time and put myself through college. And I wanted to open restaurants. I loved the business, but I saw a bunch of artisans, chefs specifically, who weren't really business people. So my framing, my modeling was that restaurants were more of a passion like project, an arts project, rather than a uh, a business. But I always had this nagging feeling like it could have been done differently. And so I'd written the business plan for my first restaurant. I don't know, maybe after I was in financial planning for 13 or 14 years. And it took a few years to get the gumption to do so. But when I had economic security from the financial planning practice, my brother was my partner. We were doing very, very well. I said, hey, listen, I want to start spending some of my time and put a team together and open a restaurant. And that was 16 years ago. So I had been in the financial advisory planning business for, I don't know, 16 years or something like that by the time I opened my first restaurant. Turns out the first restaurant we opened it was a different group of partners, of course, became one of the most successful restaurants in the history of San Francisco. And I'm not exaggerating. We just got lucky. We caught lightning in a bottle. So we saw an opportunity to turn it into a company. And so for the last 16 years now, we've been kind of opening up a restaurant here, restaurant there, and building an infrastructure and an executive team, and going from mom and pop operators to now I'm executive chairman, and we've got a board of directors, and we're a C corp, and we're going to raise 25 to 50 million on our next round, and we've my chef I hired at 24 is the CEO of the company. He's in YPO now, and it's turned into a real thing, but it wasn't the original intent.
So that first restaurant, what kind of restaurant? I'm just curious if you don't mind
It was
sharing.
an Italian restaurant in California we call Calital, California Italian, which is to
Okay.
say Italian influence with California sort of ingredients, seasonal, local. It was gastronomic. It was not like a pizza pasta joint. It was
Mm-hmm.
a little
High
bit more
end.
sophisticated. I hate to call it high end because we had servers wearing whatever they want and loud rock and roll music, and
Okay.
lights were low and candles were bright, and it was cool, very hip, really rad place. It's become a little bit more refined and sophisticated because when we got James Beard nominations and all kinds of awards and this and that, the demographic shifted. It wasn't neighborhood, cool San Franciscans. It was a lot of tourists because it became part of the foodie checklist of San Francisco place you had to eat at. And so it's become a
Mm-hmm.
bit of a gastronomic tasting menu Italian restaurant now, but it didn't start that way.
And did you start recreating the same menu with multiple as you got to the 7, or you totally different restaurants?
Yeah, we're scaling. We have a more casual concept called flour. The first restaurant's called flour plus water, like the ingredients for dough, pizza pasta dough. We then opened flour plus water. We call flour and water pizzeria, and we're scaling that. That we're trying to scale into a national concept, and that menu will be essentially the same from place to place to place. But up until flour and water pizzeria, we were creating one-off new restaurants without any true benefit of economies of scale.
Oh, wow. So at this point, you've had this business out for what, 15 years almost in the restaurant
16,
space?
16 years. The first
16
restaurant
years?
opened 16 years ago. Yeah.
Wow, that's awesome. And this business obviously is something that you had a massive passion for, given kind of where your background was. I mean, you hear the stories of, restaurants are some of the worst investments. They fail frequently. I mean, how do you think about what you've done in being successful and being, investing in restaurants and scaling and now growing and going into a national brand, hopefully?
Yeah, importantly, I haven't invested in the restaurants. We get investors. We seek capital from other investors. I'm a restaurateur, an entrepreneur that creates restaurants. Um, but we have made our investors money. Those that have invested in our restaurants, they've done very, very well. I have a hypothesis because I know the fail rate in restaurants is by reputation very high. I've actually never looked up what the actual fail rate is, but my hypothesis is if in fact it's a higher fail rate than most other businesses. My hypothesis is that it attracts capital very easily. The wrong people attract the capital easily. What do I mean? Chefs attract the capital. Chefs are not business people. They're artisans. At best case scenario, chefs are good managers of people and inspiration, but rarely are they natural born business people, and they're not trained in culinary school to be business people. But yet, rich people want to write them a check, and so the chef goes out on his or her own and opens a restaurant, and they don't necessarily even have a well-vetted business plan. More importantly, they don't have what I call a healthy relationship with capital. It's more abstract. And so they just have to have that chandelier, and they don't do the cost-benefit analysis if, in fact, that chandelier is going to improve the bottom line or maybe just be a waste of money. And so that's that healthy relationship with capital that I think I bring to my restaurant company. That I think we have across the company now, but maybe I was an important reason why we had it at the early stages, whereas I had partners who maybe were a little bit more artists.
Yeah, makes sense. So your financial planning business you've had for several decades now. Talk to us a little bit about, getting that started. Did you know in college that was the route you kind of wanted to go?
No, like I said, I grew up poor and worked full time through college as a waiter in a fancy restaurant. It was 1990. I was about to graduate a year later. I went to the library, looked up when books existed, which the highest paying 4-year degree job was coming out of college. It was stockbroker. So I said, okay, I'm going to be a stockbroker because I just didn't want to be poor anymore. And I just pursued a job. I got a job at 44 Wall Street, a little brokerage firm. And, to the extent that I deserve credit is I always, the people around me, I'd say 99% of the people I started in the business with were out of the industry within a few years. Bigger fail rate than restaurants probably. And that's because so many people want to have things happen quickly, the path of the hare rather than the tortoise. And I really did always have even as a younger person, I had the view of building things the right way. What I mean is one client at a time. I said that earlier. And not doing the wrong kind of business. Oftentimes, you're faced with limitless opportunities as an entrepreneur, and you can see one is a good, clean business consistent with your mission and your ethos, and the other is shorter term reward, but maybe inconsistent with your mission and your ethos. I always, or at least after a couple of years of floundering, chose the type of business that was consistent with my mission, which was to build a generational and sustainable practice, one client at a time, take my time, and do it the right way. And if we lose one client every 3 years, that was a bad year. And we grow 20% a year without trying, by referral only. And I really do believe that's because we just really took our time and we didn't respond to the get rich quick type of options for business choices.
Starting a business is one thing, but actually growing it, that's the real challenge. I remember before using Shopify, it felt like a never-ending maze. Managing inventory, handling payments, figuring out how to actually get people to check out. It was overwhelming. Then I found Shopify, and let me tell you, everything changed. Suddenly selling was smooth, seamless, and actually fun. I could sell on my website, through social, even in person, and now business is booming, and I barely have to think about the back end. It just works. The best part, I'm using the same platform that brands like Momofuku, Gyms, and Chamberlain Coffee trust to power their businesses. If they rely on Shopify, why wouldn't I? Nobody does selling better than Shopify. Home of the #1 checkout on the planet. And the not-so-secret Shop Pay, which boosts conversions up to 50%. That means fewer abandoned carts and more sales. If you want to grow your business, your commerce platform needs to be everywhere your customers are. On the web, in your store, in their feeds, literally everywhere. Businesses that sell more sell on Shopify. Upgrade your business to get the same checkout. Upgrade your business to get the same checkout that we use. Sign up for a $1 per month trial period at shopify.com/unveiled, all lowercase. Go to shopify.com/unveiled to upgrade your selling today.
Yeah, that's interesting. Tell our audience a little bit, there's different designations, there's kind of different terms between advisory and planning. Do you mind kind of getting into a little bit of the weeds on kind of how to
Yeah,
navigate what each of those look like?
I love it actually. A lot of the advisors at the larger firms, the Goldman Sachs, JP Morgans, Morgan Stanleys, UBS, um, they're investment advisors. Generally, they're not they can't be legal fiduciaries because they have their securities license, so they can get a commission for selling investment products. That is to say, they're not legally bound to put their client's interest above their own, which is the fiduciary standard. In order to be a fiduciary, you have to be independent of a large firm. The category, regulatory speaking, is called registered investment advisor. And that's what my firm is. We're registered investment advisors, and we are legal fiduciaries. We can't charge commissions for transactions. We can only get paid for advice, an annual fee, rather than commissions, if you will. And so that's a pretty big distinction. And there's another category, and it gets very confusing. I'm glad you asked the question. We see a lot of investment advisors, they even call themselves financial planners, that are at insurance companies. And really what their motivation is and their training is involved in leading with financial planning, but ultimately trying to sell life insurance, which is very lucrative in terms of commissions. So if you can't tell, I'm not all that enthusiastic about that side of the industry. I'm biased, but I'm pretty enthusiastic for the registered investment advisory side. That's what we are, and because we're legal fiduciaries. But I will say that the majority of the advisors that are at the bigger firms, they act like fiduciaries. They do really, really good work. So so long as they're not selling people variable annuities and whole life insurance that they don't need, which is the majority of variable annuities and whole life insurance sold, then I have no problem with advisors at big firms also.
Yeah, I appreciate you kind of diving into that. I feel like, unless you're astute in this, kind of world, sometimes the terminology and understanding like the differences, it gets a little murky and understanding. And I can't remember what the statistic is now. Maybe offhand, but at one point I think it was like less than 15% of firms out there were true fiduciaries, and
I think it's less than 10.
Less than 10, yeah. So it's
Yeah.
pretty small in terms of
I'm
those
surprised you actually knew that. I can count on one hand the number of people that knew that the statistic was even close to that, and the distinction. Frankly, it's kind of a big deal. I mean, I'm not going to get political, but Barack Obama attempted to make all advisors, even at the larger firms, legal fiduciaries. And in the first time Trump got in office, he had Jim Scaramucci, the press secretary, barking in his ear, and Trump unwound all of Obama's attempt at making all advisors fiduciaries. That was like literally the first thing he did when he got in office. I could be exaggerating first thing, but it was up there with the first things. And that was kind of a bummer for me from a consumer protection perspective. From a competitive advantage perspective, I loved it because I can shout at the top of my soapbox, screaming about being a fiduciary. But again, let me repeat, I think most of the advisors at the big firms are acting like fiduciaries. I really do believe that. And I was one of those, 11 years ago, I was at JP Morgan, and I'd like to think we acted like fiduciaries, and so did most of the people around me.
Yeah, for sure. So at this point, you said you've got 383 millionaires essentially you're advising at this point, or am I off on my numbers there?
We have 383 clients who have 1.1 billion in assets under management. So I don't know. It's something like that.
You're sizable. Over all these years, I mean, is there anything that you would point to, kind of coming from a different perspective? I mean, you shared, and graciously about your own portfolios, but is there anything that you've seen that you would tell our audience, like, hey, these are massive mistakes to avoid. These are things that I've seen, play out multiple times that set people up for success or what have you. I appreciate you sharing the strategies you use high level, but I'm just curious, from advising and being involved with that many people's portfolios and having $1 billion under management, what that looks like.
Well, I mean, I would say that anything you're doing, if it's not in the service of others, you're going to find yourself not happy. So just make sure whatever you're doing is in the service of others, whatever it is. You have to add value to people's lives somehow, some way, and be compensated for it. And then you can feel really, really good, and your sense of self-worth is probably going to be sustainable. I have a saying, which is concentration creates wealth, diversification preserves wealth. What do I mean? Well, why do people get rich in residential real estate when they held it for 20 years? Well, it's because the property went up 3 to 5% a year, but they leveraged it usually in their first home, 80% over 20% down, right? 4 times. They leveraged it 4 times. So if you buy $1 million home and it's worth $2 million, you didn't double your money. You more than doubled your money. You quadrupled your money because you only put 200 grand down on the $1 million home. But what you did was you concentrated your investment in one thing, and the thing worked and was leveraged. Wow, that's awesome. Same thing with a business. You start a business, you concentrate it. If you work for Apple and you stay there 20 years, we have a lot of clients who have been in Apple for a long time. Well, they got stock grants and they stayed there. They concentrated and they got rich. Well, what do they do once they're rich? Well, hopefully they diversify. They're not going to get that much richer. Certainly not the way they got rich the first time. But at some point in time, you probably should cease concentrating your energies, your focus, your investments if you win, because you want to protect what you've won. But a lot of times people bring the same energy to decisions they make after they've developed wealth. That is to say, usually they develop wealth, either they inherited it or they concentrated it, like I just talked about. And they keep concentrating it and they keep trying to grow it and grow it and grow it. And I will tell you, I am amongst the more qualified people in the world to make the following statement. Once you get over a certain amount of money, incrementally, more money is not going to make you much happier, period. But you may make decisions that give you more stress and anxiety. It could, in fact, make you less happy.
There's been a lot of studies done on that happiness number from somebody who's got a net worth north of 10, worked with all sorts of people, on this spectrum. Is there a number that you've seen that you would point to on that spectrum?
I instinctively felt this a long time ago, but I finally read it and I had data to support it in Malcolm Gladwell's book, David and Goliath. And in there he cites, I call it the Gladwellian U curve, the econometrics U curve. What did he say? He said, he cited a study that showed that once you made, this was years ago, and not adjusted for geography, but once you made $75,000 a year of income, you reached peak happiness and you stayed there. No matter how much more you made, you plateaued at that level of happiness until you hit 400,000 of income. And when you made 400,000 of income, you got less happy. That's the U curve, right? It goes up, goes flat, goes down. I think it's too totalizing. I don't buy it. It has to be adjusted for geography. I can tell you in San Francisco, New York, and adjusted for inflation, 75 grand is not going to get you to peak happiness. But I do think it's, I don't know, 200-300 grand is going to get you to peak happiness. And I will say I've seen a lot of people get really wealthy that are really miserable. I've seen it, and it's really sad. And there's a big difference, again, I said earlier, between net worth and income, right? Income is what you can spend. Usually net worth, you'd like to think, gives you surety above and beyond your spending and maybe generationally, right? So, again, my net worth is high, but I can't spend my stock in my financial planning company or my stock in my restaurant company or my homes. I get income from the first two and I live in the 3 homes. They're not really providing me with cash flow to go to dinner or vacation or give money to charity or whatever, right? So I am a big fan of understanding the difference between income and net worth. And I do think that people should try to get to combined household income of north of 100 grand. And if they keep finding themselves agitated to grow when their income has grown so much, because they think that they're going to be happier. They should question that. And it's okay to then turn your direction to focusing on your net worth, I think.
Awesome. Well, David, let's wrap up with some rapid fire questions. What's the most expensive pair of shoes or pants that you've purchased?
I'm probably not the right person to ask that. The most expensive pair of shoes was probably $300 pair of boots, and the most expensive pair of pants was probably a $250 pair of jeans.
Okay. What about the most expensive meal out?
Oh, I like that. I'm a decent person to ask for that. I mean, I've spent $1,000 a person more than 5 times.
Nice. Any favorite other than your own restaurants or places that you'd recommend?
Oh man, I just love food. There's a restaurant in San Francisco that's my favorite restaurant in the world called Ernest, Ernest. It's literally my favorite restaurant in the world. Oh man, in New York City, where do you start? Where do I start? Just
Endless.
endless.
That's awesome. What about the most expensive car or toy?
I have a Porsche Macan GTS. That was the most expensive car I'd ever bought. At the time, it was $83,000. I understand that they cost like $120 or something like that now, or maybe more. It just turned over to 100,000 miles on my drive back to my home to get on this meeting with you.
Oh, wow.
So I have 100,000 miles. I've had it for, yeah, I know. And, I can afford to buy a new car, and I kind of want a new car and probably should buy a new car, but getting new like that takes time, and you have to think about it and deal with it. And I don't want to think about it and deal with it. So
I hear you. What about the most expensive experience or vacation?
I do a helicopter snowboarding trip every year that costs about $15,000 or $16,000 for 7 days.
Is that local there in California? You go up to Alaska,
Canada? No, I go up to interior British Columbia. Yeah.
Awesome.
Yeah.
What is worth it to you to spend the money on?
Oh, that's easy. Experiences with people you love. Whatever it is, whatever you need to spend, what you spend as much as you can afford to spend reasonably on having experiences with the people you love.
What is not worth spending on?
Things that don't connect you to people.
What was a key lesson that you learned from childhood?
It's always people. It's always people. Be in the service of people. Make sure you love and are loved. That's it. My mom taught me that. And she taught me that not with words. I watched her. She modeled that for me in the way she lived her life. She's still alive, lives her life. But when we were young, I observed it.
What's the craziest thing that you've ever done to earn money?
Oh man, I was the manager of an Italian-American restaurant in Wildwood, New Jersey, right out of high school. And I was not qualified, and the guy gave me the job because he was in the mafia. And he was making crack cocaine in his basement, and he drove me back to Philadelphia to show me his lab, and I continued to work for him. I was not making crack cocaine or selling crack cocaine, but I think indirectly I was somehow connected to crack cocaine.
Oh, man. Pretty young to be exposed to what may have been going on there.
19 years old. Man, what a lesson.
Oh, yeah, that's crazy. How did you make your first buck?
I was a waiter, so I was getting tips, and I loved it. What a great business. The money you make per hour as a server is as high as I can imagine anything you can do per hour. The hours you work, usually nights, are great. You can make so much per hour. You could work 4 nights a week and make a real living. I put myself through school doing that while you go to school during the day. And then, as I said, right out of college, I one client at a time built my financial planning practice. So, yeah.
What's the dumbest thing that you ever wasted money on?
I just bet $1,250 that my Eagles were going to lose because I wanted to emotionally hedge. I wanted to emotionally hedge that if they lost to the Chiefs, that I'd at least get $1,250 winnings to soothe my misery, and my Eagles won. So I suppose that was the dumbest thing I've ever done, and it just happened on Sunday. But I think it's logical, actually.
All right. What's something you spent way too much money on you don't regret? Maybe it's that same thing.
Yeah, right. Dinners. I love good food. I love, I don't have I don't think buying expensive wine is worth it. That feels like a trophy. I'm not a showy kind of person. I think buying trophy wine it's just not worth it. But, I know the margins at tasting menu type restaurants, they're very, very low. They're usually like 5%. They're terrible. Those restaurants barely make any money. They truly are passion projects for the chefs that are there. And I will spend whatever it takes to eat at some of those restaurants when I'm in the mood for that kind of meal. So I spend a lot on those meals and I don't regret it.
What's a closely held belief that you once had that you recently changed your mind on?
Oh man, you just totally, building a home would make me happier, and it's made me less happy.
How come?
Because, it's one of those things where I had a home in Lake Tahoe. People could come visit me, so it satisfied that primary objective that I know is in my core philosophy of life, which is have your money invested in things that can bring you close to people. But I really love design, so I wanted to build a home. And so I put 4 years of my life into designing this architectural masterpiece that I'm sitting in right now. And I am less happy than I was with my much more humble home that didn't have anywhere near the complexity and problems that this home has, that everybody that walks into and sees is so blown away and impressed by. And all I can think of is, what do I got to deal with tomorrow?
Oh, man. As I'm in the middle of building my own right now.
I hope you have a more
it's going well. I'll put it that way.
Good,
my wife
good.
is ecstatic.
Yeah.
But I hear you. There's different stressors that come with it. And of course, I got 5 young kids, and I'm like, man, we just built stuff on this floor. Like, what's gonna be in the next house? Because that's not changing in a few months,
Totally.
Oh,
that's it.
Any last pieces of advice for somebody who's just starting out on their journey?
I alluded to it earlier, but all human motivation, by my estimation, and every time I'm interviewed or write anything, I always come back to this core philosophy belief I have, which is human motivation. Once you satisfy your base needs of food and shelter and you're warm and dry fed, so to speak, is you want to be loved and valued. And that's it. That's your human motivation. So if you go into any negotiation, or you have a boss or an employee or a team member, maybe you don't love their behavior, I think you can find empathy for those people in those situations, just knowing that really they just want to be loved and valued. It doesn't mean that their behavior is functional and you should maintain the relationship regardless of how they treat you, but it does maybe give you a little bit more room to be patient.
Awesome. That's Dave with a net worth north of $10 million. Thanks for on the show today.
My pleasure. Thanks for having me.
Thanks for listening to the Millionaires Unveiled podcast with Jace Mattinson. For more stories, investment opportunities, and information, check out our website, millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.